In this week's update, significant momentum returning to local critical mineral stocks, US indices at new all-time highs, and why it should continue. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. Okay, let's start with the market perspective. The global market just remains totally fixated and besotted with all the chatter about rate cuts, but there is certainly far more likelihood that we are going to see at least one rate cut this year, and the market is not going to get derailed by that. So that's the bigger picture. Now, the data is a bit mixed at the moment. It depends on which data point you're looking at, but inflation still appears to be contracting. There's the odd data point that comes along that scares the horses a little bit. But when you look at it over the last 3 to 6 months, inflation really does appear to be continuing on the sort of path that is not going to upset the stock market. I think that's the overall summary. And when we look locally, the bit of a jump we saw in unemployment through the week certainly helps the RBA in terms of not raising rates. I don't know about a rate cut in Australia because, the budget and government policy is not helping inflation, that's for sure. But the important thing for the Australian market and for the Australian consumer is that we don't get a rate increase. And that bit of a tick up in the unemployment certainly helped that. Now, there is a high level correlation between copper and the S&P 500. It's been that way for decades. And there are very, very few instances where a positive move in copper, as we're seeing, and we'll get to that shortly, does not directly correlate to a positive upward move in the S&P. That's just the long-term history, and it makes sense because a rising copper price is about economic expansion, global economic expansion, and that's good for stocks. So that's the bigger picture positive. And at the moment, okay, the US dollar has gone down a little bit, that's helped, but the copper price has gone up by a lot more than just the currency effect. So you can only read it as a sign of relative economic strength at the moment. So that's good. It's also, the copper price is also being helped along, of course, by the imperative around decarbonisation. And whilst the deficit for copper has looked absolutely inevitable and a no-brainer, similar thing happened with uranium from 2019. That looked like an absolute no-brainer, but it really took another 3, even 4 years for the uranium price to start to move. And similarly with copper, it just appeared so obvious where copper would end up, but it just took a frustratingly long time to actually get going. But now it is, as you'll see from the chart when we get to that section. So these are all positive things for commodity stocks. They're positive things for the market in general. So this is a pretty positive video, I've got to say. Turning to the American market, the S&P was up 1.55 and the Nasdaq did a bit better than that, just above 2% for the week. So a good finish. And it's going to take something that currently isn't on the horizon to stop this market. As I said earlier, yes, the odd inflationary data point comes along that scares people a little bit, but it's not a trend. It's just a one-off piece of data here and there. But having said that the indices should continue to advance, earnings season has shown that there's an incredible diversity between stocks whose results are well received and those whose stocks are really badly received. And a stock of interest to the Insiders Club members is an American stock which missed revenue and earnings expectations by 1% on both lines. But the stock price fell 10% immediately and then another 3 or 4% after that in the coming days. So it just shows that the treatment is very savage for stocks that are not beating expectations in virtually all respects. So your individual stock selection is still absolutely critical. The US dollar index was down about 1%, or 1 cent, if you like, in those terms. 10-year yield also fell. We're back down now to 4.43, and that certainly helped the technology sector. And the VIX came off again a little bit, about half a point down to 12. Let's jump in and have a look what's happening in the US market. We'll start with the S&P first of all. So this is the weekly chart. We had a 3-week sell-off in April, which was unexpected. April normally positive, but May, which is supposed to be a pretty crook month, actually did very well. And that's becoming a real myth because, as I observed last week, 9 of the last 10 Mays have actually been positive. So you want to forget about that tired old slogan. So a good finish for the week for the S&P. And if we look at the NASDAQ, also set new all-time highs as well. That's a daily chart. Just a quick look at the weekly. So looking very similar to the S&P. Importantly, semiconductors continue to do well. Eased a little bit on Friday, but net were positive for the week, and that's always good for the market. And if we look at that spread between the semiconductor index and the S&P index, we're still trading up near all-time highs, meaning that this rising line means semiconductors are outperforming or rising faster than the S&P is, and that's good for a healthy market. Looked at over the last month, finance has done really well. The banking sector has jumped up and is leading the way in the US over the last month. Interestingly, it's a real strange mixed bag because consumer staples have also picked up as well, but at the top of the queue is technology and healthcare. So we've got a real mixture of aggressive and defensive sectors. So it's not really giving us any sort of clear bias at all. So that's the US market. Again, just, don't worry too much about the sectors. It's very much about individual stock picking. In Australia over the last month, we've seen a bit of a pullback in the information technology stocks, but I would expect, given the positive finish that we saw in the US for those stocks on Friday night, we probably should have a pretty bright opening for the information technology sector in Australia on Monday. Healthcare had also done really well, but look, everything in the Australian market got well and truly slammed on Friday. It was a very disappointing session. So everything is sort of turning down with the exception of materials. And you would expect materials will get another boost on Monday. And pulling up the rear, no real surprise in Australia because energy policy is just such a disastrous mess, thanks to successive governments having no idea what they're doing when it comes to energy policy. And those stocks are dragging the chain by a significant margin. So a quick look at the currencies. There's the US dollar down sharply on Wednesday and pretty much stayed there, and the Australian dollar doing the inverse and starting to head back up towards the top part of its trading range. The Australian market, 66.31 is where our dollar finished. Our index rose 0.8% across the week. That was including the drag that we saw on Friday, but that'll reverse, I would expect. Across the week, materials, gold did well, and the discretionary sector did quite well, which is a bit unexpected given all the chat about cost of living pressures. Last week, I said that a sustainable super cycle looked possible in commodities, and we saw a terrific week in Australia for commodity stocks, and even for a lot of the beaten down developers that are still years away from reaching commercial production. And we saw stocks like Chalice and Vulcan Energy and Liontown Resources across many different resource areas, critical minerals areas. So there is a clear acceleration in support. And what we saw on Friday night in America did little to change that outlook either. So critical minerals projects definitely getting support back from the market again after probably the best part of 18 months where the market didn't want to know about it. Was it short covering? I think in some instances that is a bit, because the budget certainly offered support to critical minerals projects. So there could have been an element of short covering. It's a bit early to say just on a couple of sessions evidence, but certainly the bigger picture when you look at the potential deficit situation that we're in so many commodity areas, including precious metals, with silver, that it wouldn't be surprising to see this as the start of a very significant new bullish phase. So we'll just check the Australian market very briefly. So that was the Australian market on a weekly chart. We've broken out, we've retested, and now we're sort of starting to move away again. Friday, a little disappointing, but that may get erased on Monday. Now, turning to precious metals, this is silver. Silver on a weekly chart, all-time highs happened back in April of 2011 and again in August of 2011. We broke out from this trading wedge about early April, so about 6-7 weeks ago. It was a breakout, ran up to what was then a triple top, came all the way back, retested the breakout, so technically this is perfect, and then really surged last week. That's a terrific surge. Now we'll have more resistance up here, about 35, and again in the mid to high 40s. But silver, as you can see from that chart, is really starting to move extremely quickly. And this is not just speculation. Yes, it's getting a bit of help from the US dollar, but this is very much about the silver supply and demand. But silver is in a production deficit, and the inventories, the long-term inventories that have supported silver for years when there's just not been enough silver being produced to meet demand, those inventories now are getting pretty skinny. And that's what the silver price is responding to. And if we look at the relative comparison chart, this is between silver and gold in US dollars. The balance is, and you can, this is over the last, so this goes back to November so it's the last 5 years, in fact, is the common base here. So you can see for a lot of the time over the last 5 years, silver in the green has been outperforming gold over the last 5-year period. And certainly in the last little bit, it has really accelerated away. So the balance is shifting even more in favour of silver. We've got quite substantial and increasing industrial demand. Now, a lot of it is for solar panels, and the forecast for the photovoltaic capacity is to keep rising at about 30% plus per annum. That's from the International Energy Agency. That's one heck of an increase in demand, 30% into a market that is in deficit already. And it's also a market where, as I said, inventories are not going to be able to cope with the difference. Supply is constrained because silver mostly is not a priority metal from production. It's a byproduct of producing of other precious or base metals. So virtually no one out there is looking at the silver deficit situation and thinking, oh, we'll increase production of silver. no one's budgeting up to produce more silver. So, whatever silver comes out of the ground is what comes out of the ground because of other materials. So we've got a market that's already in structural deficit. We've got inventories that are getting very, very skinny, and we've got a supply response that is probably not going to respond. So it's no wonder that silver is doing what it's doing. Okay, gold. Must forget gold. And it hit a new all-time high at 24.14. This is gold on a weekly chart. So looking extremely good. And in Australian dollars, we've had a bit of a dip because the Australian dollar has bounced. So that's sort of held this back a little bit. But still, it finished above 36.07. So just wrapping that up, gold up $53 to 2414. Talked about all those things with silver at 31.49, and you can add that to the long list that we're getting of critical minerals and precious metals that are in structural deficit. GDXJ, we'll have a look at that as well, is starting to play catch up. And in Australia, there's a couple of silver stocks that are really, really humming, and they are getting focus in the Insiders Club and also in Portfolio Analyst. So let's just jump back and take a quick look at those. GDXJ. So this is a long-term chart for GDXJ. It looked a lot healthier back in 2011, the last time we had a really serious bull market. And it was trading up GDXJ around 156. We're now down in the mid-40s. There is a huge way to go if the current indications are about a sustainable bull market in gold continuing. And you can see we're just starting to break out now. We've had a gain of 24% this year to date in GDXJ, and gold futures are up 17%. So that's calendar year to date. Now, stocks over the longer term, once you start to get the leverage effect, because gold miners' costs are largely fixed, and increases in gold just go straight to the bottom line. So generally you see indices like GDX or GDXJ amplify the gold move by about 3 or 4 times. So if gold goes up 10%, then you would expect to see the gold miners' indices go up by 30 or 40%, something of that nature. We're starting to see some catch up, but it hasn't really started the acceleration, the big acceleration. So improving, but still not bringing in the volumes yet. And if we look at a relative comparison between the Australian dollar gold price and GDX listed on the Australian market, so this common currency there, you can see that the gold in Australian dollars has actually done better. So our gold mining stocks are still lagging. So there's still plenty of potential for our gold market and our silver market stocks to do very well. All right, that's positive for precious metals, all good news. Copper really surged up to $5.08. Nickel also up more than $1 to $9.94. And we got a big double top in copper. I actually wrote this on Thursday before the final session of the week, whether it was time for consolidation because the copper price was sitting at about just on $5. But it ended up another 10 cents higher than that. And so we've actually got a very, very minor breakout. But copper's had a terrific run. We could just get a bit of consolidation here. So don't go stampeding into copper stocks, assuming that everything's just going to continue. Crude oil worked its way higher into the end of the week to $80, helped by the US dollar being down, and also US inventories were down as well. Uranium update. The US government has now invited bids for up to $3.5 billion on providing nuclear reactor fuel, and they also signed into law the banning of import of materials from Russia. And that unlocks $2.7 billion in funding to help develop the US nuclear fuel industry. And we saw major moves from the big players, typically 5 to 7% up on Friday alone in the US. So very, very positive in the US, and that should be reflected in our market on Monday. The US, the uranium price currently spot around $90 a pound. There's the spot copper chart. We've really taken off since the start of April. We've gone from 4 to just over 5, so that's over the last 12 months. But if we look at it over the last, I must have missed one. I had a chart here of, I must still have it hidden, sorry. Anyway, on a 5-year chart, we've got a big double top from previous peaks at $5. So yeah, the message here is just don't get too carried away with stampeding into copper at the moment. There's always good opportunities on a bit of a pullback. There's the spot nickel chart, also shown a very good increase as well. And there's crude bouncing a little towards the end of the week. Wrapping it all up, look, this is a market just to be treated on its merits. The parts of the market that are doing well, the sectors and the stocks, if they're a buy, then just, according to your rules, then just go ahead and buy them. Don't allow preconceived ideas to get in the way. Trading and investing is hard enough as it is without getting bogged down with all this, old wives' tales tend to be told out there. It's all about being clear about what you're trying to do, clear about your process, having some patience, having some discipline. If you can do those 3 things, you're going to do better than just about anybody else in the stock market. And that's where success is found. Success is not about getting the latest UBU tips from somewhere or other. It's about a consistent application of process. Portfolio analyst last week, a couple more strong long-term investments that I'm really, really keen on, and also a bit of an overview of where things are at globally. That's it for this week. There'll be no video next Sunday as I'll be traveling, so a 1-week break. More information on the website, and there's my email address. I'll be back with you in 2 weeks. Cheers.